Back. My name is David Gibbs. I'm with CME Group from Chicago. Glad to see so many of you here. You can see by the title of my presentation, I'm going to be discussing the newly launched Bitcoin futures. There we go. We're going to start by speaking in general terms about cryptocurrencies and other digital assets, and then gradually work ourselves down into the index that CME helped create called the Bitcoin reference rate, on which this futures contract is designed, and then give a couple of very general trading examples of how the contract might be used. And then at last, a couple of slides with some additional reference points or resources for you to use to perhaps look into this a little more fully. It's a brand new world, this whole cryptocurrency business. And so like all of you, we're kind of learning as we go along, okay? Cryptocurrencies, nice technical expression for what is basically a digital asset. Not really currencies are used to create transactional business, buying and selling of one thing for another. And certainly cryptocurrencies could be used for that if you can find people that will exchange their goods for your cryptocurrency, right? So there are quite a few of them. More are popping up every day. This isn't anything that's going to go away anytime soon, but it will ebb and flow depending on market conditions and so forth and so on. The most common or most frequently quoted, at least, are Bitcoin, Ethereum, Ripple, Litecoin. Those are examples of cryptocurrencies. Our product focuses on one in particular. Where do they come from, and what is this stuff? Well, it's based on a paper by a pseudonym of a person or a group of people called Satoshi Nakamoto. And if the paper's available online, you can make a PDF copy for it and read it yourself on the whole concept. The principles behind it are actually very cool. And as I mentioned in my remarks, if you were here for the panel discussion, the idea about blockchain technology is brilliant. And it is something that I think will be with us for a long time to come. And it's going to revolutionize, or at least change, a lot of things in terms of the financial community, in bookkeeping and transactions and the flow of capital around the world. But Bitcoin and other cryptocurrencies are the product of an algorithm, a mathematical algorithm that computer programmers and other people try to solve in order to create the coins themselves. And there's a limited number of them, 21 million of these Bitcoins, which they expect will take many, many, many more years to create the balance of them. It's important to note, therefore, that in order to create them, you have to be involved in what is now referred to as mining. And the mining of fresh Bitcoin is not only a calculating function, but it involves enormous amounts of computing power, and then as a result, enormous amounts of electricity. The amount of electricity that's being used to run these systems in these pictures, what you're looking at these are mining operations. What you're seeing in some of those frames are the computers or the servers themselves, and others you're looking at the ventilation systems that are necessary to keep them from overheating. They draw an enormous amount of power. Some of these mining operations are drawing enough of electricity to power a small city. That's how much and how big these things have gotten. And with each incremental production of new Bitcoins, it's becoming harder to produce the next ones. So this is an operation now that takes enormous amounts of resources. An individual sitting at home on his laptop computer is going to find it very challenging to be able to compete in this sphere for creating new coins. So, what's the idea behind them? Well, the concept is basically, by being a digital asset, no central bank can control the creation of the flow or manage who gets to do what transactions for what purpose, and also they can't delete the currency. So it's supposedly very efficient. It's very secure because it's done in a cloud-based system where all of the creators or miners of Bitcoin, in order to approve a transaction, must do it in unison without banks being involved. It's meant to be more cost efficient, but all this remains to be seen in terms of accessibility. These are examples of cryptocurrencies. You can see based on the market cap that Bitcoin is by far and away the largest. We're going to be looking at the currencies of this list that fall into our reference rate, our currency reference rate. Not the exchanges that list the Bitcoin. In terms of comparing this capitalization with other assets, you can kind of see where it falls in. By estimates here, all the cash in the world apparently adds up to $84 trillion. To my knowledge, Jeff Bezos isn't quite to that personal wealth figure yet, but that could be just a matter of quarters away. The stock markets, which are huge, represent 69 trillion and so forth, all the way down the curve, and you can see Bitcoin slides in there, representing roughly or a little bit more than half of the total cryptocurrencies. So what is Bitcoin? It's as we've already discussed, it's one of the cryptocurrencies. It's probably the most one that's been batted around the most frequently. It's the one that is mostly referred to, and it's a peer-to-peer electronic cash system operated in the cloud. In order to get a Bitcoin, you either have to mine them or buy them, and that's important. Once you get them, they have to be stored in an electronic wallet. And in order to use them, you have to be able to exchange them via the connections through wallets that can be confirmed by other people within the Bitcoin mining area. Okay, why the interest in this? Because there is concern worldwide about fiat currency. They're very popular because they're anonymous. And there's a limited supply. There are, these are the top 10 Bitcoin exchanges based on volume. What we're doing is using, we've identified 4 that we're working with to draw data to collect for our reference rate, but you can see there are others here. And the clearinghouse will be monitoring all of these exchanges to identify if we want to add or subtract from our list of people that we're currently drawing our information from. This is just a price chart. You can see for many, many years, since just in the last couple of years, Bitcoin as a price was pretty flat. And then suddenly, just within the last 6 to 18 months, it's taken off dramatically. Almost need a logarithm chart to follow that in terms of price activity, but it's just crazy in the last couple of years. It's a very volatile marketplace as well. You can see the reference rate versus the others on an annualized basis here. So in order to create a futures contract, CME is very conscious of its role, both as a clearinghouse and an exchange operator, of being able to manage and measure risk. So in this case, in order to create a futures contract on an asset that is very difficult to get your head or hands around, we wanted something that would be less subject to price manipulation in terms of its pricing component. And so over a year ago, working with Crypto Facilities Limited out of the UK, we put our heads together and came up to form this Bitcoin reference rate, or the BRR rate. And it's pulling information on a trade-weighted basis from those 4 Bitcoin exchanges that you saw on the previous slide at a fixed period of 1 hour toward 4 o'clock London time, and publishing that on a daily basis and also producing a live version of the same index. So the futures price is based off this BRR rate. that's been published now for over a year. The BRRA was launched in November of 2016. There is a committee of people that supervise this function. There's 7 members of this oversight committee. CME only has 2 seats on that committee. The others are from either third parties or market practitioners in the industry to make sure that we're doing things properly and that we've considered all angles on this. It's a once-a-day reference rate, but there is a live version of it quoted on our website. And the calculation measures are also public that are listed also in brochures and papers published by CME and crypto facilities. You can see the constituent members at the bottom. GDAX, Kraken, ItBit, and Bitstamp are the contributing exchanges providing actual trading data on their Bitcoin transactions. Again, that's the Bitcoin reference rate since its inception, following the same pattern, obviously, of the Bitcoins themselves. Okay, this is really what the futures contract is all about. You want to take the time to investigate the contract specifications because we're not talking about the Bitcoin currency. But what I'm talking about is the Bitcoin futures contract. And a futures contract is a standardized product. It has a standardized unit. It has minimum tick fluctuations. It's trading on a regulated exchange on CME via Globex with regular trading hours, reportable limits, all kinds of the things that go into a regulated listed futures product. So here they are. One contract constitutes 5 Bitcoin, and that's defined by the CME CF Bitcoin reference rate. The minimum tick fluctuations are $5 per coin or $25 per contract. It's trading on Globex during our regular Globex hours, 5 p.m. Chicago time to 4 p.m. the following day. You can look up the product code is BTC. And we list 2 months in what we call the March quarterly cycle, March, June, September, December, and then 2 additional months around that first quarterly. So currently, this being the month of January, we have a January contract, a February contract, the front March contract, and then the deferred June contract. 4 contracts that trade at one time. When January rolls off at the end of the month, February, March, an April contract will be listed. The last day of trading is the last Friday of a contract month. And it ends at 4 p.m. London time, not Chicago time. And it will be fixed on that date to the Bitcoin reference rate that will be established on that date. So there's full convergence to the reference rate by time of expiration. It is a cash-settled futures contract for obvious reasons. It's hard to get, you can't deliver product that you can't. So this is cash settled. Because of the volatility in this product, which is huge, by the way, we've imposed daily fluctuation limits of 7% from previous day's settlement, 7% and 13% and 20%. 7 and 13% limits are what we call soft limits. In other words, if the market trades up or down to 7%, the market will take a pause. And if the next trade moves off that level, so be it, everything is great. If it gets stuck there, the market could pause for 2 minutes in order for the book to rebuild bids and offers. This is a very common practice at CME for contracts that are highly volatile. The 13% would be the next limit, and if it hits 20%, that's known as a hard stop. Trading will cease if it goes up or down by 20% within a one-day trading period. Trading limits exist in other CME products, like our agricultural suite still has fixed daily trading limits, where if the market reaches that certain threshold, the market could technically stop trading in that product. Other contracts that have similar trading restrictions would be something like the S&P 500, which is regulated by the Securities Exchange Commission and also has soft limits on basis to slow down trade if it gets too volatile. And it's ironically, it's about the same, 7 and 13%, which are important numbers to keep in mind. You can read this at your leisure and follow the same things here, but the 20% is a hard stop limit. This is a snapshot from Bloomberg, just showing you the volatility in this product, both on an average and on a daily basis. This is, I think in annualized terms, has a volatility, at least recently, of about 150%. So this is not to be traded by the timid. You could blow out your account in less than one session in a product like this. The volatility is serious, and by the way, the margin on this product reflects that. We're currently requesting margin from our clearing firms of close to 47% of the value of the underlying product. That is always, like everything else at CME Clearing, subject to change without notice, so that if the product becomes even more volatile, the margins will go up and the clearing firms will ask for additional funds from their client base. So like all of our products, our clearing firms have the right to ask for more funds over and above what the clearinghouse asks of them. And in a product like this, I can virtually assure you that they will. Volatility requires security. And that's the function of both the exchange and the clearinghouse, is to make sure that there are funds in place to secure open positions in volatile contracts. So you can appreciate the fact that the margins on these products are significantly higher than traditional commodity and financial futures products. This just shows you examples of the standard deviations at various volatilities on this type of a thing. This was based at the Bitcoin valuation of $15,000 a coin. The moves on these are real. This is very consistent with the market activity which is seen presently with this new listed product only being several weeks old. Those are massive numbers. So again, this is not for the timid. There will be position limits in place. We've talked about the initial margin. There are other Globex credit controls that are also in place on this and every other financial product. And you may need to check with your futures clearing merchant or commission merchant to see if they are in fact participating in the use of this product. They also may or may not be ready to list this on their systems yet. Okay, why would CME jump into the mix and voluntarily list a contract on something that's as volatile as this? It's because it's our job. It's our job to create products and services that are used in risk management practices and also attract a wide variety of users to create liquidity in products that the public either requests or needs in the management of their ongoing affairs. And in the case of this, it's like any other futures product to us. Our clearinghouse would not have accepted this responsibility if they didn't think they could manage it. And the management of the risk compared to other major events that have shocked our marketplace in the last 18 to 24 months were easily, well, not easily, that's not the right word, but were effectively managed by CME Clearing. These include the Swiss franc volatility move of 2013, the Brexit vote in the middle of the night session in Chicago in June of 2016, and the record-breaking results after our surprise election last November created enormous periods of short-term volatility that, because of the risk management principles imposed by CME Clearing on its contracts and on its members, we were able to get through all of those events without any problems whatsoever. So it's our job as a clearinghouse to measure and evaluate the risk of the underlying and then to impose our risk management principles on the product and its users accordingly. So that is really what we're speaking about. Let's look at a couple of examples to see how this product might be used. The first one would be, keep in mind these are illustrative only because I don't know any Bitcoin miners, nor do I know anybody that's trading these things outright. So let's just assume on January 17th, a few weeks ago, a week or so ago, that the BRR reference rate is roughly at 10,600 as a price point. And that as a miner of Bitcoin, I currently own 943 of these lovely little Bitcoins. I've got roughly $10 million of underlying Bitcoin risk. What if I'm concerned about price devaluation? I want to lock in a certain profit on my underlying Bitcoin position, but I don't want to take myself completely out of a price appreciation. Given the volatility in this product, I certainly would like to participate if it doubles in value shortly, but I'm a little bit more concerned about the market selling off. So I'm going to put a 50% hedge on my current exposure. How would I go about constructing such a hedge? Well, if we look at the March 2018 futures contract, the first quarterly contract available to trade, it would be trading at roughly 10,700 at a slight premium to the BRR index. So the first thing we need to do is to calculate the notional value of the futures contract. And that's done by applying the multiplier of $5 per contract times the contract price. In this case, the notional value would be $10,700 on the futures contract times the $5 multiplier, or $53,500 per contract. I'm going to take that number versus my $100 million risk exposure, which I want to hedge half of, or $5 million, and divide my notional value of the futures contract into that to arrive at the number of contracts that I want to sell. So if we have to round to a whole number because you can't trade fractional futures contracts, at least not at CME. And we end up with 93 March futures contracts that I'm going to sell short to cover my exposure. Well, what happens? A month or so later, on February 20th, assume that the Bitcoin price has gone up to $14,000. That means the futures contract would have traded up alongside it. Now, the degree that it goes up or down to the index still remains to be seen, and I'll discuss the pricing mechanism in just a few minutes. But let's assume that it goes up to 14,020 per contract. The miner's position, her total position of 943 coins is now worth $13 million, or a gain of $2.2 million on the total position. But wait a minute, the futures hedge was put on as a short position, so she lost money on that on the hedge. Perfectly acceptable, because she was concerned about locking in the loss if the market sold off, accepted the responsibility that the market traded higher. She'd make money on the one side but lose some on the other. The loss is in a magnitude of $1.5 million. So she made roughly $1.7 million net of the position, participating in the rally. But what would have happened if the market had sold off? Bitcoin would have sold down to $6,000 a coin, and the futures would have traded down to 6,020. The miner's total position now would have lost $4.3 million. She's not nearly as happy with that result, but because of the 50% hedge, she made back $2.25 million, or suffered a loss of a little bit less than half than she would have had the total amount been exposed to the sell-off. So you can see from a miner's perspective, there could be some value here to being able to manage the risk of a net long position in the underlying. What about somebody that wants to participate that doesn't have any coins? The beautiful thing about a futures contract is you can go long or you can go short. It doesn't make any difference to the exchange. You just have to support your open position with the proper amount of margin that's required to secure it. So let's take a look if we'll continue this exercise. If the miner wants to continue that role, that position from March into the next quarter of the contract, they're going to have to do one of two things. They're going to have to offset the position and reset it by rolling the spread, or take on an additional trade. But the March contract will eventually expire. So rolling forward in this case means if I'm short the March and I want to continue that hedge going forward, she's going to be selling the March-June calendar spread. Now, in the Bitcoin futures parlance, like the stock index futures, the action on a roll is always described by what you're doing the second month. So in this case, by selling the June and buying the March, she's selling the spread. Now, her long purchase spread will offset the short position in the March contract, and then the short position in June represents a new initiation of an open position in the longer dated June futures contract. Spread activity in this market, we expect to be just as active as any other futures contract of a similar size and development. So you will see people trading the spreads both to roll positions and at some point might be speculating in the spreads themselves. If I don't own the Bitcoin and I want to take a long position, I can certainly do that too. Let's take a look at somebody who just wants to go long a Bitcoin future. On January 17th, if we assume a long position in the February contract at 10,875 and you buy one Bitcoin, your notional exposure is times 5 contracts, or $54,375. You're going to have to put up almost half of that, but more than $25,000 in cash to secure that position under current market conditions. Again, the margins are subject to change based on volatility. So what would happen here if the market were to $21.25 per contract, or in this case, almost an $11,000 profit on the position, without having to own any Bitcoin as an underlying? So could there be a marketplace for this? We think so. A couple of things to compare the futures to the spot market. Do you need a Bitcoin wallet to trade Bitcoin futures? The answer is no. Do you need, is there capital efficiencies or leverage involved? There is. Like most futures contracts, you're only required to put up initial margin and maintain your margin position with your FCM. Clearinghouse is managing the risk. You can sell these futures short without having to, for example, in the cash Bitcoin, you can't get short. You can't borrow them from a broker-dealer and sell them short. This is really, at least for the moment, this and other futures products on cryptocurrencies is the only way to lay off risk or sell them short. It's through a futures contract. But we'll see how it develops. I would very strongly suggest that you do your homework on this product and on this marketplace before participating. These are just examples of some references and some resources that we find useful, both about our products and about, you can do a Google search on the currency and cryptocurrencies in general. But I can't stress enough how important that I feel that you understand this, both the concept and the contract, before wading into the marketplace, because it is highly volatile. The daily swings in this thing are massive. And because it's a new product, the liquidity is not as deep as other well-established futures products. We're currently trading somewhere between 1,000 to 1,500 contracts a day with open interest of about 1,500. It's nice to see that there's activity in all of the 4 listed contracts, most of it in the front quarterly contract. But investigate it. If you think it's useful and fits your risk profile, you're welcome to give it a try. But again, couldn't stress enough, highly volatile, highly untested in terms of an underlying product. Trade them at your own risk and understand that that's exactly how we'll be looking at these things, managing the risk of the underlying, the index. So if I can answer any questions, I'll be happy to take them at the moment. Otherwise, I wish you the very best of luck. Thank you. Anyone have any thoughts or questions? Yes, ma'am.
What's happening now? And the second question is, Bitcoin has its characteristic as it limited. So Bitcoin future, will it affect this particular characteristic of Bitcoin?
Okay, 2 questions here. One, because the underlying asset has a limited supply, if I get this right, would that limited supply at some point affect the futures mechanism itself?
Will the future the price of the Bitcoin? I believe that.
Okay, thank you. Will the pricing of the futures contract ever affect the pricing of the underlying?
Yes.
Question number one, liquidity. It's very slow, very small to start. Like most contracts, they take sometimes a long time to develop. This one in particular has gotten a great deal of media attention, but because there isn't, unlike a lot of our other contracts that have a connection to some commercial activity, to my knowledge, there is no commercial activity regarding this product other than the mining of Bitcoins. And because of the newness of the underlying product itself, liquidity is going to be, to develop a deep liquidity pool is going to be a challenge. Let's just say that. As I said, we're currently trading somewhere between, say, 1,000 and 1,500 futures a day, but it's only a month old. We haven't even gone through a quarterly roll cycle. With open interest at only 1,500, it's a very, very, very small contract. In terms of will the activity in the futures ever influence the price of the underlying, that also remains to be seen. I don't know. Are there instances historically of futures contracts influencing price behavior underlying? I wouldn't say directly, but again, in traditional futures space, our contracts are derived from an underlying asset or something that is also tradable. So what imposes the integrity of the pricing of the futures contract is an arbitrage relationship between that futures contract and its actual underlying product. In other words, if the S&P futures, even the S&P futures, were ever to stray in a price band beyond what it would be either too cheap or too rich to the underlying index, some very smart arbitrageurs would step into place and simply buy the cheap product and sell the rich one and spread them back into line. This happens all the time in all of our products because that's one of the functions of the derivative product is to reflect the underlying values of the underlying product. And being able to buy and sell them, futures contracts, buy long or short, you can impose trading activity that can reinforce the pricing integrity by arbitraging, and actually if you have to go all the way to expiration to get your profit back. That's going to be very difficult to do with a Bitcoin because you can't sell it short. And in a case like this, that's imposing a challenge for the pricing mechanism of the contract. Now let's just think for a minute, how would you price the futures contract? What pricing formula would you use? Well, let's see. Let's consider it like we would a physical like gold. Gold is an asset, but it doesn't pay any coupon income like a bond. It doesn't convey any right of ownership in future earnings like a corporate stock. So how do you evaluate gold and gold futures? Well, gold's got its own price. It moves up and down with the transactional interchange value of the actual physical product. The futures contract on gold arrives at its value based on formulas based on storage fees, insurance, what we would call in my business the cost of carry. What's it, because gold isn't paying any income, what keeps it from going down? It costs me money to store it, it costs me money to insure it, it costs me money to move it around. Those are tangible inputs that I can get my hands on to value the contract, or the forward value of the futures contract or the forward. Bitcoin doesn't have any of those things. It doesn't have any storage costs. It doesn't have any insurance costs. It doesn't have any transportation costs. So how do we arrive at a forward value? It's very difficult. And in this case, because the physical can't be shorted, but the futures contract can, there may be downward pressure on the futures contract as a result that wouldn't inherently be there, that might cause, at least in some traders' minds, sort of pricing anomaly that can't be spread back out of because you can't arbitrage it. So it's going to be a difficult, very tricky thing to value. relative to the reference rate, which is based on transactions that come from those exchanges, Bitcoin exchanges, which you saw earlier. So these are challenging things to be thinking about. And look, we're going to be watching this thing as closely or closer than you are, just to see how this stuff plays out. So yes, we would like to see the volume in the open interest world, but I'm equally interested in watching the pricing behavior with the futures relative to the spot. So thank you for your question. Did I get close to an answer there? Thank you. Anyone else? All right then. Well then I will thank you for your time and your patience and wish you the very best of luck. And thanks again to Philip for inviting us to participate in this wonderful forum.